Okay, today I'm going to talk about the PPO ADX indicators that I have found to be a pretty reliable indicator to identify reversals to the upside. Um, I first learned of this from attending a webinar that was presented by Wendy Kirkland. I first learned um, how these indicators work from her, and I try to find additional information uh, or research on how these indicators work, but there hasn't really been a lot out there. I don't think many people are familiar how these work, and so I wanted to put this video together to basically explain how these work and show you some examples, and hopefully you can use these indicators to identify those reversals to the upside. And you can use this to whether you're trading stocks or options. I'm just going to briefly explain what each one does and then how they work together. So basically the PPO is the percentage price oscillator, and what this does is that it measures the difference between two moving averages as a percentage of the larger moving average. So it's probably similar, or you could say it's a cousin of the MACD for those of you who are familiar with that. So it runs from a positive to a negative value, and when it's positive, it means that the shorter moving average is above the longer moving average, and that usually means that the stock is rising or in an uptrend. And when it's negative, the longer moving average is above the shorter, so that's indicating a downtrend, or the stock is moving under the moving average, and so forth. The ADX actually has a few components, but I'm not gonna get into the other components because the most important piece of this is the main ADX, the average directional index, and this measures the trend strength regardless of the trend direction. So when it's above, the value is above 25, it means that it's a strong trend. When it's under 20, then it's a weak trend. So let's just get started with some examples. I use freestockcharts.com. This is a great site for technical analysis. You can use a lot of different indicators on here, and so it's definitely one of my favorites. And I'll show you how this works. So basically, what you want to do is you want to set the indicator, the PPO, to be the first, or actually in the middle here, and then the ADX on the bottom. So the PPO should be on top, the ADX is on the bottom. And as you can see, the values here, from 0 and up, the positive value, and then the negative value, again, that's indicating that the stock is in the downtrend. And again, ADX, anything above 27 means a strong trend, under 20 it's a weak trend. So basically, my understanding on how this indicator works is that you're identifying stocks that have been beaten down up to a point where the selling has been exhausted, and that's what the ADX is identifying. Basically, right here you can see that starting in, and I'm using COP as the example here, um, back in January 9th, that's when the strength of the decline has been rising. So you can see the stock has been going on a decline, and the trend strength has been rising. And again, the PPO is just showing that the stock is trading under the moving average. So when these two lines are converging here, getting very close together, that's your signal. That's showing you when to go long on this stock. So in this case, if you were to purchase, let's say at the high here, which was 64.40, and then you can see that on the ADX, the trend strength is actually declining, which you may think it's counterintuitive because now there is no strength when it goes up, which is true, but when you see the examples, it actually does show a reversal to the upside. So again, now you see the lines are actually growing apart here. So if again, this example, you could have bought at 64.40. You could probably sold at 66.72. But then you can see that the stock has been declining. So this one, the stock has been chopping along, and then you can see that it's starting to increase again, and you could probably take in your targets right around 66.70. Probably the most difficult part of figuring out is when to take your profits. Usually, based on my analysis, it's best when the PPO is approaching zero. So once you see that this line is crossing zero, that's usually your target. Yeah, you should either close your position or take at least a big chunk of your profits off, because anything can happen after that, and I've seen reversals that easily have occurred. I mean, this is an example that it just kept going up. But usually a time frame here, from when you do your initial buy, is probably anywhere from 1 to maybe 3 weeks the most. So you're not going to be holding any positions longer than that, or shorter than that. But this is just one example. It's not the best example, but I just wanted to point this out. The next example is actually Tesla, and this I first identified back in November. If you follow me on Twitter or stock tweets, I did identify this back in late November, and I actually noted the line on where I was stating that you should go long for the stock because it was indicating a reversal. So this was back on November 26th. So going back here, you would have bought probably, let's say, at 120, because again, you can see the lines are pretty much meeting. Even if you waited an extra day and you would have bought at 127, you watch how the stock just rips to the upside. And again, I would have taken a profit right when the PPO value is approaching zero. So that would have given you a price target of about 148 or so. So you would have went long around 120 or even 127, and you would have sold at 148 or so. And depending on your risk tolerance, you could have held longer. But then again, this is why I recommend you take profits right when the value hits zero, because the stock can easily start chopping or reverse. So that's Tesla as an example. Let me give you another example. Goldman Sachs was one that I recently identified back in February. And okay, right around here. So again, you can see the lines are converging. Stock has been on a downtrend. The key is to buy. You can go early. You can. This is what February 5th. You could have went long. Because what you want to do is to buy before these lines start going in the opposite direction. But let's say you bought at the high here, almost 163. Now watch again how the stock just starts ripping to the upside. And again, you would have taken your profit right where the line crosses, or the value crosses zero. So you would have taken probably about 170. You would have bought around 160, maybe 163 if you missed it. And again, once you go beyond the value of zero, you may want to again close out your position, because again, this is a perfect example where it could easily reverse. So that's another example of when uh, the indicators are indicating a reversal. Another example is on the SPY. And also I noted this in my Twitter or stock tweets, and I actually put the arrows on where you would want to initiate a position. So this would have been probably on the 4th, but let's say 4th, again, you could have probably waited till, what is this, the 6th. So let's say you bought at the high, 177. And again, the stock just rips to the upside, taking a profit right around where it crosses, about 183. And then if you want to continue to hold and try to squeeze more profit out, you can do that, but you're gonna be limited to a possible reversal or just choppiness. So again, that's another example of where the stock, uh, the indicators are identifying that reversal or break to the upside. Now, as I mentioned, there's no indicator that's 100% accurate. This does not always give you a proper breakout, and I'm going to show you a few um, stocks here, just an examples that show you where the signal was there, but the stock did not perform the way you would have hoped. So here is AT&T, and as you can see, the the stock again has been declining from early January, and this is about early February. So right now, right around this February 6th, the indicators are showing that you should go long. So you could probably take a position again, probably about 32, depending on when you initiate that. Um, Again, 32, and then you can see that actually it starts going higher. And if you're quick, you could probably have taken a quick profit there, but it starts chopping. And as you can see, the PPO never gets to zero, and actually the stock starts declining, and there's a failed breakout. Uh, of course, it's showing here that the stock starts ripping up to the upside, but again, you're not looking for a time frame of over a month. We're only looking for breakouts that last anywhere from 1 to 3 weeks. So this is an example of where the indicator showed to go long, but the stock failed to break out. Give you another example where this has occurred. Coach, and again, you're watching the lines converging. You could probably start taking a position right around here. So it's about 48, and this was back around late January. And then again, the lines keep converging, so you could probably continue to take a long position or add. But then you can see that it actually starts chopping and doesn't really do a breakout. The stock pretty much stays below this resistance level of about 49, almost $50. And even though the indicator starts going to zero, you're still not making a profit. Uh, because again, our time frame should not be that long. You're looking for a few weeks. This is already a month, so this has failed. So if you don't see the stock breaking out by the third week, just close the position and just move on. Don't wait till the stock breaks out, because it may not necessarily work that way. Another example is BK, Bank of New York Mellon. You can see again, this is in early February. The indicators are showing to go long. You could probably would have taken a long at around 31, and then you can see that the stock looks like it's going to break out. It reaches a high of about 32.27 on this date, but then it fails. And again, you don't see that the PPO is heading to zero. The stock is not really breaking out. Uh, you got to close up position. Um, I mean, in this example, it does break out, but you're going beyond the time frame that we're looking at. Um, so that's again another example that it's not 100% accurate, but most times, probably about 8 out of 10 times, the indicator does work. So here's one example where I don't know what's going to happen. I've showed you examples that have occurred in the past. So of course you may say, well, you pick and choose the stock that shows that the indicators do work, even though I did show some where it failed. But today is March 21st, and again, you can see that this is the last date, um, Friday, March 21st. Indicators are showing a possible reversal here. If it was yesterday, you could have bought probably anywhere between 210 and 219. Today it popped up to 237. So next week we should see whether this stock will continue to reverse to the upside. So in a week or two, you can, depending on when you watch this video, you'll see whether again this indicator has worked, whether it has identified a reversal, or it's possible that this can fail. So um, again, it's not 100%, but it's from the various stocks that I have analyzed and done research on. I would say maybe 8 out of 10 times it has identified a breakout. So hopefully you found that this indicator is helpful. It is something to add to your arsenal when doing analysis, whether you use technical analysis, fundamental analysis, whatever the case may be. It is best to use this as a supplement. Don't use this as your only indicator. Um, but it's something that does help. So hopefully you have learned something, and hopefully you can use this, and it will benefit you and you can profit from this. So if you have any questions, let me know. So thanks for watching.